Hello everyone, in this video we would be starting with CMT level 2, chapter number 10 and chapter number 11. So these two chapters would be completed in this particular video, and I know that I'm not going according to the exact chronological order which is given in the book, but that is okay, don't worry about that, we'll cover all the chapters. And in case you wish to watch all the chapters of level 2, then make sure to join the membership, and I've given the link below in the description box. It's a little over $1 for a month, and within this particular month every day I would be rolling out a new video. So in this chapter we'll be seeing what are bar chart patterns. I know most of us use candlesticks and we don't really use bar charts, but bar charts have always been a very important part of the history of trading. So we'll be learning about these. We'll be seeing the controversy of whether patterns are our imagination or are they actually existing. So there are very famous people who really are against the idea of patterns. They think that patterns do not exist at all, but there are people who have done a lot of research on it and who do believe that patterns do exist. Okay. Influence of the computer technology. So earlier when computer was not there, then trading used to be a very tedious task. Like, not only trading, the gathering of data used to be very difficult, but now that we have computers, that has become really easy. Classic chart patterns such as triangle. So we'll be seeing what are the chart patterns, and we'll be seeing what are rounding chart patterns. So like we have the head and shoulder and stuff like that. Then we'll see what are half mask chart patterns. So half mask chart patterns are usually the flag and pole and the pennant pattern. Okay. And then we'll see how to determine price objectives. Okay, so in this particular chapter, we'll be seeing the short-term patterns, right, first. So what are short-term patterns? Short-term patterns means that we are talking about 1 day, 2 day pattern, or we are talking about one particular candlestick. So that is basically short-term patterns. Okay, so you need to keep in mind that the patterns can be complex and they can also be very frequent in nature, right? So one thing you need to keep in mind that the more frequent a pattern is, the more there are the chances for it to fail. Because if some pattern is very frequent, then most of the people are already trading the pattern, right? And if most of the people are trading the pattern, then the pattern basically loses the value it had, because more and more people have now discovered the pattern. For example, the W pattern, the M pattern. So these kind of patterns are very obvious now, and most of the people already know about the pattern, due to which the probability of the pattern is now less, the probability of success. Okay, so what exactly is a pattern? A pattern is just a configuration of the price action. So whatever price action is going on in the chart, the pattern is basically just its configuration, and it can either be bounded, right? It can be bounded above, it can be bounded below, or it can be not bounded at all. So if you're talking about the M pattern, so you know that it is bounded above. If you are talking about the W pattern, it is bounded below. And if you're talking about some, let's say, some pattern like this, it is bounded from both sides. So that is the concept of bounding. Okay. Okay, and then you know that curves can also be there. So not only we don't have a horizontal resistance or support. Sometimes we can even have a curve, something like a cup and handle. So here you can see a curve. This curve is acting as a support region. So it's not necessary that all of them will be in a straight line. Okay. All right. So now let's go to some of the characteristics of the patterns. So first thing is the entry and exit. Every single pattern which we would be studying in this chapter will be having an entry and will also be having an exit. Okay. So we'll study that in detail. For example, look at this basic things: resistance, support, and here if you want to buy here, then you will enter over here and the price will go till the resistance. So when the price reach the support, you purchased it during the support, and here there is a breakout, and when there is a breakout on the downside, it pulls back up. Sometimes you can enter here if you want to, and it can go down. Okay, so breakout and pullback. So there are two terms which are used in CMT. One, you have the throwback, and one, you have the pullback. Pullback is when there is a breakout of the support region and it comes back, it pulls back up. And throwback is when there is a breakout from the resistance region and then it throws back. So that's the difference between pullback and throwback. It's the same meaning. Okay, and then this is one very important concept, which is the fractal nature of the patterns. We have done this in level 1. So, the fractal nature, when we talk about the fractal nature of the patterns or the fractal nature of the technical analysis, it basically states that the patterns which we study are valid on any time frame. Obviously, the accuracy and everything that depends and that might change, but whatever concepts we are learning, they are fractal to all time frame charts. Whether I'm using a 5-minute chart, whether I'm using a daily chart, a monthly chart, a yearly chart, or even a 1 second chart, the fractal nature remains the same. That is something you need to keep in mind. Pullbacks and throwbacks I've already discussed. Failures. So, breakouts can always fail. It's not necessary that a breakout will always sustain. Breakouts can always fail because, like we have discussed it before, now more and more people got to know about technical analysis. So, because of that, since more people know about it, there are chances that the technical analysis concepts, which are very well known, might not be that, might not really work that well anymore. So that is failures. Breakout can always fail. So that's the reason why you have to always confirm your breakout before entering into any trade. Okay. Now this is a very important discussion which is done by many people. Do patterns really exist or do they not exist? Some people actually believe that the patterns do not exist. So they basically believe that the price action, which is what is happening in the chart, is basically just random or it is due to some fundamental reason. Whereas people like me, I believe that there are um, patterns or there is the price action which is going on is not random. I believe that there is a reason why it's happening and there is a technical reason why that is happening, and I 100% believe in technical analysis. So yes, people have been arguing about this over the years, and until now nobody can say that whether it exists or not exists. It's according to each person's personal belief, but there has been statistical um, results showing that technical analysis is a real thing. Okay, so behavioral finance and pattern recognition. So we need to acknowledge about the chart patterns that they have not been proven to exist or to be profitable. Okay, you might be wondering that I literally just said that it is statistically proven. Now, why am I saying that it's not? The thing is, if let's say I want to trade a W pattern, is it possible for me to apply the W pattern on all time frames of all the stocks of all the markets? Is it possible for me to do that on every single time frame, on every single stock, on an instrument, and on all the markets? It's not possible, right? How can I do that? That is not possible. So that's the reason why they are saying that it is not scientifically proven, like on that way. All I can do is I can backtest one chart, but I can't really do that kind of backtesting, right? So that. Okay. Humans have a tendency to want patterns in data and other information and to see them when they do not exist. Superstitions are derived from the erroneous and coincidental observations of patterns that do not exist but are created because of the desire to have a pattern. So, this is a very popular argument where they're saying that sometimes there's no pattern in the chart, but since we are programmed to that, and since we really want a pattern, we just start to assume and we might just say that this is a pattern. Now, that's what is very subjective about the patterns, right? What might be a triangle to me might not be a triangle to you, right? So something which I can see visually, you might not see that. Humans are similar in the desire to have some kind of stimulus, even if it is a black cat crossing the road, and develop a supposedly predictive relationship when none actually exists. So, can we actually prove the black cat superstition if it's true or not? We can't really prove that, but we still believe that. So, that's how human brains are made, and that's the way we think, and that's the same kind of thinking which comes to the stock market as well. Humans are also poor statisticians and tend to put more weight on recent history than what is statistically warranted. An experiment by Kemen and Tversky showed that in flipping coins, which have a statistical probability of landing on their heads 50% of the time. Obviously, when you flip a coin, you get a head or a tail, so 1 by 2, so that is 50% of probability, right? So, observers began to expect more heads in the future when the sequence of the head turned up more frequently, and they were surprised when they did not occur. So that's the thing about humans, right? That we see the recent, we give more weight to what is happening currently and what is happening recently as compared to something that has been happening before. So that is what they are discussing. Humans also tend to see the future as the past. So if something has happened in the past, we obviously make sure that if something unfavorable happened in the past, then we make sure that that doesn't happen in the future. So that again. In a world without change, the best way to find cheese is to return to the location where it was found previously. In a world with change, however, the best way to find cheese is to look somewhere new. So this was given by Burnham. So it was paraphrasing from Johnson. In other words, the chart pattern and trend reader should look for failure rather than believe in the constancy of previous patterns. So before you take any trade, before you follow any pattern, you need to do your own backtesting, right? The profitability from the failed patterns is often greater from the correct patterns. Okay. Alright. So computers and pattern recognition. You might be wondering that why do we have to manually study about this and why do we have to manually recognize patterns when computers can do it for us now that we have computers. In fact, we have some supercomputers and AI and everything. The thing is, computer does not make the study of the patterns easier. Why? Because computers, again, it's very subjective in nature. Patterns are subjective in nature. Something which might look like a triangle to the computer might not look like a triangle to you. So that. And also, patterns change and adjust to the new market. So with this continuous rapidly changing markets, you need to also be changing your patterns. Now that is something which the computer cannot do, and for that you need to have a human hand, right? So that. And also, I told you that how the patterns are subjective. Tests are being made currently on their validity. Okay, so these validity tests are being taken. In fact, they have been done from quite a while now. Okay, so quantifying a chart pattern is something which is not easy because the patterns are very subjective in nature. This is how the art of technical analysis developed before the computer. And although the computer is now taking over both in plotting and in analyzing, the chart patterns still exist and are used by many practitioners. Okay, so when you talk about the longevity of certain patterns, so that would be something which is not true for all of the patterns. Some patterns might be true now also and might be true even 10 years later, but some of them might not be true later. Okay, so when you talk about computers, computers are very good at quantifying normal stuff. Like if I want to, let's say, find the ratio of today's close with yesterday's close or stuff like that. Now those are the kind of things which humans cannot do that quickly, right? For that you take the help of computers, and computers do that in less than a second. So that, so there are advantages because we are able to backtest many things. We are able to test much of data and stuff like that. But if the old time technician is there, then they rely on their experience and they know that they've been trading from years and they know which patterns work and which patterns do not work. Okay. Okay, now we come to the market structure and pattern recognition. So, market structure in basic, if I want to tell you, I think you all must be aware that this is an uptrend, this is a downtrend, and this is a sideways trend or a range bound market. These are swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low. So I think these are the basic things which you already know. Now let's do. Okay. So like I've discussed, technical analysis has been evolving with time, and so is the market, right? The markets have changed so much and they've adapted to the new interest rates, the new things, the new everything. So technical analysis is a concept which is constantly evolving in nature. So that is something to keep in mind. The proliferation of the technical knowledge has led to the recognition of specific patterns when they occur. Of course, once a pattern is widely recognized and acted upon, its effectiveness diminishes. That's what I've been explaining, that once many people know about the pattern becomes less effective in nature because everybody knows that now, right? And it's very easy to manipulate a pattern because now I know what is a pattern and I know that retailers might buy on this pattern, so I will take the advantage of that liquidity. Okay, all right. One more thing you need to keep in mind, that when there are trading securities which few traders watch, which are not very, let's say, which are not very well known to everybody, some low key stocks, on them when the patterns occur, they work out. Now, why is that so? Now, let's talk about the Indian markets for a second, or let's talk about the US markets. Okay, I'll just come to that. If I trade a W pattern on the Nifty 50 index chart, then the probability of it to fail is more. Why? Because more and more people, most of the people keep a check on the Nifty chart. So the pattern might be less effective. Let's say if I trade a penny stock, maybe people don't know about the stock. Very less people are trading in that stock. In situations like that, the chances of the pattern to be a success would be more. So that's what they're saying. Okay? Alright. In the stock market, ownership has become concentrated in relatively few hands that tend to act in concert. These hands, so what are these hands? They are the institutions, they are the institution holders who have a lot of net worth. They basically plan together and tend to be together and then place a buy or sell order. So they tend to act together when the news is announced. By their large positions and anxiousness to get in or out, they cause patterns to self destruct. Although it is difficult to prove, when a large institution is the dominant owner of a stock and has knowledge of technical principles, there is a temptation to manipulate a chart. Now, that is the reason why failures occur. Because if I'm a, let's say, institutional trader, and I have an institution and I have funds more than a million, let's say, and I am more than 100 million, and I want to trade. I know the stock which I'm seeing, I know that there is a W pattern occurring over here. I know that retailers, normal people, normal individual traders would now buy over the breakout. So I will cause the breakout to happen. People like us will buy and enter into that, and then I will start selling my heavy positions and I will hit all their stop losses. Now I can manipulate the chart because of that. So that is something to keep in mind. Okay. Alright. Finally, the advent of derivatives in large quantities has influenced the price and volume action in individual securities for reasons other than the prospects of the underlying company. Addition or deletion from a market index or baskets can suddenly introduce buying or selling. Very obvious. Okay, so these, I know it's not clear, but these are basically some of the books which they're advising us to read. Okay, now let's come to the actual bar chart patterns. Give me a second. I will just check. Okay, so these boxes are not clear, so let me just get my book. Until then, just read this. Okay, so we already know what are bar charts. We've already seen that in the level 1 as well. And the price behavior um, is like we can see the price behavior very clearly when we are using a bar chart, right? So bar chart patterns are formed by combining support and resistance zones and trend lines. In all cases, a pattern finalizes when a breakout occurs from the pattern. So that's what we are basically going to learn about. And we need to always keep in mind that not every breakout is going to be legitimate. We need to always confirm our breakouts, and if our breakout is not confirmed, then we should not enter into the trade, and there are chances of our breakout to fail, because of which you need to always keep a stop loss, and managing the risk is the first and foremost thing. Okay, all right. Okay, so we divide patterns into two categories. The first thing is the continuation, which means the trend is continuing. So if let's say a uptrend is going on, then the trend will continue towards the upside, or there is a reversal, which means now the trend is going to be on the other direction. So this is the way we divide the patterns into these two categories. All right, and moving on about that, let's also read what's written over here. Patterns cannot always easily be relegated to a specific reversal or continuation category. So there is a lot of work which goes on before deciding, like after a lot of back testing, they have basically come to this conclusion, and you need to keep in mind. How profitable are patterns? So, see, it all comes down to the same thing which we have discussed again, the effectiveness. If more and more people know about it, once a pattern is widely recognized, then it basically loses its effectiveness. And I know that is like something which we don't think about, and we just see a W pattern and we enter into the trade, but that would lead to that would basically lead to false breakouts, right? Because there is a chance of manipulation. The problem is the difficulty in defining a chart pattern on a computer. So we cannot really define it since it is very subjective in nature, right? And one of the authors devised a method to identify patterns by recording the sequence of reversal points relative to their immediate past reversal points. So now, using 5 of the reversal points, one of the person basically um, uh, defined it so that it would have been more easier. Okay, and results show that chart patterns as defined had little predictive ability. Several patterns showed some statistical reliability, but not enough to prove that the technical things are good. See, that's what I've said, that it's not possible for you to test every single thing on the market to prove something. Okay. Many of the statistics mentioned in each pattern section later in the chapter are taken from his most recent work. The intriguing nature of Balkowski's studies is that many of the old observations seen in the classic literature are turning out to be questionable, especially for maximum performance. As examples, volume trend with a pattern, slope of trends, breakout volume may not be relevant as others had originally thought. Remember that Bolowski's observations are in retrospect. We can easily identify many chart patterns after they have occurred and when we have observed the results. See, now if I go on backtest on TradingView, it is very simple for me to do that because the patterns have already occurred. But when the real time market is going on, it is very difficult for you to actually identify whether a pattern is getting formed or not. So the real power or the real talent is when you are able to identify the patterns on the real time charts. Okay, let me open my book since the box is not visible at all. Okay, so the box 10.2, which is over here, can you see the box? Just a second. Yeah, this one. What it's talking about, it is basically saying that breakout price, how do we use a breakout price to set targets? So bar chart can basically project price targets once a formation completes with the breakout. Most targets are measured from the breakout price. So how you measure, let's say for example you are measuring a W pattern and here there is a breakout, then you will measure this area and you will place it from the breakout area and you will book your target over here. Okay, let's come to classic chart patterns. Now let's look at these. Double top and double bottom, the most easy thing. We all know what is a double top and we all know what is double bottom. The reason why I'm not going deep into it is because we have done it in CMT level 1. So let's just go over it. The tops are rounded and wide with some irregularity. The two peaks must be with or within 5% of each other's top price level. So if I have something like, let's say, this, this is not a double top pattern. Why? Because the difference between this top and this top is very high. So you need to make sure that both of the tops are within 5% of the distance. But and the middle valley should be around 10% or more from the lowest peak. Okay? So 5% and 10%. Keep that in mind. The double top also is like a rectangular formation, because when there is a rectangular formation also the price oscillates like this. So here also we can see that double tops are formed. The only difference is that there is no breakout over here, and it is continuing in the same range for a while and not just for two peaks. That's the difference. Okay. A projection from the break below the trough under the measure rule that hypothesizes a decline equal to 73% of the distance in points from the highest peak and the trough. Okay, so that's what I said, that you need to measure the 74% of this and then book your target over there. Okay. All right. Okay, so now you need to keep something in mind. 64% of these patterns of double top and double bottom fail to penetrate out of the breakout level. So if there is just, let's say if there is just like this and there is no breakout, then in that case we won't enter into a trade. So 64% of the trades will have a failed breakout. All right. So keep that in mind before you start trading with your real money. All right. The failure rates are 11%. The failure rates are 11%. So what we just saw, which was the 64%, 64% is when we don't get an entry because the breakout only doesn't happen. So the breakout doesn't happen and the price continues to go in the original trend. So that is the 64% where you don't get an entry itself. But when you get an entry and then you hit your stop loss, the statistics of that is 11%. So the odds of making the profit from a double top downward breakout are minimally risky. And Bolowski also said that 2 out of 21. So double top is very very profitable according to Bolowski. Keep that in mind. Okay. So how do you basically trade the double top formations in the real chart? So if one observes a double pattern, several important observations must be made before acting to improve the chances of profit. First of all, never buy until the breakout has occurred. So we are going to wait for the breakout to occur. Just because I can see that M is formed, I won't just enter. I will wait for my M to breach, only then I will enter into a short position, right? And let's say if there's a W pattern, I will not enter just because I see a W. I will wait for a breakout to happen over here, only then I will enter into the trade, right? Second, look for flat bases either at the same level as the twin bottoms or slightly higher than the earlier. So you need to make sure that these two have to just a second, yeah, you need to make sure that these two are on the same level or nearly same level. They need to be very close, and the same thing for this as well. So you need to keep that in mind. Third thing, look for an absence of consolidation area above the formation. So I will explain that on a plain sheet. Okay, so if I'm, let's say, trading a W pattern and okay, W pattern, and there is a breakout. So before I enter, I will see that previously, let's say here the price was choppy. Then will I enter into a W pattern? No. Why? Because if I enter over here, my price might become choppy and might come down again. So what kind of a chart you need before entering? You need, okay, just a second. Yeah, you need that, let's say here the price was normally coming down. So you see that the price is not choppy. So in that case, the price, there is a chance for the price to go really up. So you need to make sure that there is no consolidation before the pattern. You need a clear trend. So you need to keep that in mind. Okay. And the fourth thing is, look as what is called the even eve variety. Volume doesn't seem to be important, although it is usually higher on the first hump. So usually people say on the first hump the volume is higher and then it goes down, but now that is not that important, but you should consider that if you want to. Okay. So if you go on the real chart, I don't want to look for examples since we'll be short of time, but let us still just see. Okay, if you look at this chart, do you see a double top? I see one. So I can consider this to be a double top. Okay, because, and you can see the tops are a little bit away from each other, but they're pretty much close. And here it broke out and it actually gave a really good see, it actually gave a very good risk reward. In fact, it gave even more if you look at this. Now, here, did all our three things match? First thing is both of the tops are near each other. Second thing is, in previously there is no consolidation right before the pattern. Is there a consolidation? No, there's a clear trend which is falling down. And if you zoom out also, you can see that there is a clear downtrend going on before the pattern formed as well. So which is why my pattern succeeded. And if I would have entered over here, I would have entered below this red candle, or I would have waited for a pullback. So here there is a pullback and I would have entered somewhere below this candle and I would have booked this entire thing. So that is how you trade the double top. You can backtest it yourself. If you won't backtest, you will not remember anything which you are studying, because this is a very practical kind of a course and you need to backtest it with the trading view charts. Okay, next we have the rectangle or the trading range or box. So whatever names out of the three you see, all of the three mean the same thing, which is a rectangle. A rectangle is when the price is basically not creating higher highs or higher lows, or lower lows and lower highs. The price is trading between a particular range itself. So now that is known as a rectangle. If you want to, you can see a particular example. I can't really see a clear example over here. Okay, right here. So if you look at this place over here, okay. So do you see a rectangle over here? From here to here. The price is only trading between this rectangle and here it broke out. So the chances are that it will go up from here. So that's how you recognize rectangles. Now, what exactly is the meaning of rectangle is that rectangles are bounded above and below. That you need to keep in mind. And if you look at this is the resistance line, this is the support line, and the you can enter over here if you want to. The price is oscillating here, and here it is basically shortfall is the last thing where it failed to touch the previous low. It made a low which is higher than that. That already shows us that the now the trend is ready to break out. The stock is ready to break out, and then it breaks out, throws back, makes a candle again, a bullish candle, and it goes up again. So that is how you are going to trade a rectangle when it breaks out on the upside, and when it breaks out on the downside, you know you'll just do the opposite. Okay, so when we have, now let's discuss a important concept, which is the false and premature breakouts. False breakouts or premature breakouts, what are they? So these breakouts are not exist just a second, these breakouts are not exits from formation, but they are instead a minor breakouts above or below the breakout levels and quickly return into the formation. So sometimes what happens, there is a breakout and for a while there is a breakout, and after that the stock again comes back and starts trading inside the range again. So this thing is known as a premature breakout or a false breakout. Now, how do you save yourself from entering into trades where there are false breakouts? Now, that is by confirming with other indicators, like confirming the momentum, confirming the volume, and stuff like that. Or what I would suggest the best is that wait for a pullback, wait for a throwback. Do not enter until and unless there is a throwback. By doing that, you will already avoid a lot of premature breaks, And but I do understand that when you wait for a pullback, sometimes the stock doesn't even pull back and it just continuously keeps going up. So there are chances that you miss out on that, but it's okay. At least you are able to manage a lot of risk which would have potentially caused you damage. A false breakout is one that breaks out in the same direction as the eventual exit breakout. In retrospect, these breakouts can have predictive value, but at the time when they occur, it is almost impossible to tell what type it is. When they occur frequently, they warn us that a strict breakout discipline must be used to avoid triggering action before the actual breakout. Okay, that is something to keep in mind. Just a second. Okay. Okay, now we know what a shortfall and a partial is. We've discussed that above. So, this is known as a shortfall, and the opposite of that is known as the pitfall. Partial, sorry, not pitfall. Partial. Sometimes this is a warning as to the direction of the eventual breakout. So, obviously, the last thing, like we saw in the image, the last swing failed to create a higher high. So, that basically means that, what does that mean? That basically means that the direction, right? It talks about the direction only. It talks about which direction the breakout might occur. Okay. Prices begin to reverse, but before declining, the way prices begin to reverse before declining all the way to the underlying support zone. Buyers are getting a little more anxious that the odds of increase breakout upward. So, what has Bilowski said about it? Bilowski reported that such a shortfall within the latter stage of patterns is accurate 60 to 90% of the time, but it is not 100%. Nothing is ever 100% in trading. Okay, so more than half of the time, prices throw back or pull back to the breakout zone, so providing another action point with less profit potential. Okay, one more thing to keep in mind: when a breakout occurs on a gap, the odds decrease that retracement will occur. So, if there is a gap, if a gap has already occurred, then you can't really be sure that a retracement will occur. Why? Because the gap itself acts like a support, or gap itself occurs as a support or resistance. For example, let's go here. Let's go to an hourly chart. Let me remove everything. I have my super trend. I'll remove that also. It's okay. Okay. So, for example, let us take an example that this this is my resistance region, right? This is my resistance region. The price tried to go up and it's stuck, it couldn't cross past this. So let's go on the next day. Next day, look at the candle the next day. The price is over here. Did the price come down to this and take a pullback from here and go up? No, it did not. Then what did it do? It basically opened gap up and it just went going up and up. There was a small retracement, but it was only near the gap and it went up again. So whenever you have a breakout which occurs directly from a gap, then you need to keep in mind that it might not retest again. Okay. Volume is often an important factor in any formation. So some volume, you need to really look into it, because volume is something which helps in confirming most of the patterns. In a rectangle, just a second. In a rectangle pattern, a rising or declining volume within the pattern has little or no effect. So in rectangle, the volume has no effect on the results after the breakout. Although declining volume is more common, results increase when volume is increasing on the breakout itself. So this I've emphasized so many times, that whenever you see a breakout candle, we really want that the candle has a very high volume in the breakout. So that would basically show the conviction in the breakout direction. So we really want to have a proper breakout with a proper breakout volume. So keep that in mind. Depending on the rectangle entry and exit, the failure to reach 5% was between 9 to 16%. So there is a certain amount of failure in that as well. The worst was the declining continuation pattern, entry from the above and exit down. Okay. Now, Okay, now we come to the next box, which is the trading rectangles. I know you can't see whatever is written over here, but I will read it out and explain it for you. Edward and McGee claim that rectangles are more often continuation patterns, but as a reversal pattern, they occur more frequently at the bottoms. So, just a second. Usually, what happens is when there is a trend going on, a rectangle is formed, breaks out and goes up. Rectangle is formed, breaks out and goes up. So in that case, the rectangle is a continuation pattern. But sometimes what happens, a downtrend is going on, downtrend is going on. Here there is a rectangle and then the trend changes. So in that case, triangle is acting as a reversal pattern. So these are the things which you need to keep in mind. So Edwards and Muggy are basically saying that they occur more frequently at the bottoms as compared to the continuation pattern. Okay, an upward breakout, however, should never be assumed. 2 out of 3 rectangles are continuation patterns, and the initial rectangles have the bad habit of producing false breakouts. So you need to keep in mind that the initial expected direction of the breakout should be in line with the previous trend. So when you are talking about the continuation pattern, we obviously need the breakout to be in the direction of the trend. So keep that in mind. Sometimes there are failures, and failure rate is very low once the final breakout happens, but the failures are usually called as the busted triangles. So whenever you have failed triangles, they are known as busted triangles. Just keep that in mind, since it can be come at the it can come as an MCQ. So what do some traders do? Some traders basically look for a triangle and buy at the support region, sell at a resistance, short over here, buy at a support, again sell. So now this is something which is not advisable. What is advisable is you wait for a breakout, pullback, or whatever. But do not ever trade like this, because this will lead to a lot of whipsaws. Okay. Okay, now how do you calculate a target when you're talking about a let's say rectangle? A target can be calculated by adding the height of the rectangle formation to the breakout price. So that's what I've always been saying. So let's look at this. Take an example of a rectangle and then I will understand. Okay, so this is a rectangle, right? This, let me just mark my area. So this is a rectangle, and what is the height of the rectangle? The height of the rectangle is from this high to this high. So from the breakout area, from the to this high. So from the breakout area, the same, if you, okay, wait, I can't do this. Let me show you again. Yeah, so if you look at the height of my rectangle, then it is how many points? 10 bars, right? So now I basically have to have the same measurement for my target from the breakout. Look at this. Did you understand? Wait, I'll explain it using trend line only. The height of my rectangle is this much, right? This is my height of my rectangle. Now the exact same height I will measure from the breakout area, and you can see that the target has been met. So that's how you measure the targets when you are trading a rectangle. Moving on. Okay, next we have the triple bottom and the triple bottom, and we already know what is a triple top and triple bottom. Triple top is like this, triple bottom is like this. Triple top and triple bottom basically just have another one swing added with the double top and double bottom. So keep that in mind. And you can also keep in mind that each peak in the top should be at the same level and should have the same shape. The middle peak can be slightly lower. So sometimes what happens is when you have a double top, you have something like this, which is okay, which is valid. So keep that in mind. Pullbacks are common 63% of the time. So 63% of the time the stock usually pullbacks, which is why I always say that only trade after a pullback and diminish the breakout performance. Tops only project 40% of the formation. So you will not trade until an actual breakout occurs. Looking at this, Look at this. It broke out, pulled back, and I would enter somewhere over here with the stop loss above here, and I would capture 1:2. Okay. So they rank in the top third of the classical patterns. Their failure rates are also very low. Because see, the failure rates are also low, that's also because these patterns, triple top and triple bottom, are not formed very frequently. Okay. Now we go to the next one, which is a standard triangle. Take a moment and read and try to understand the pattern, then I will discuss. Alright, so triangular patterns are basically very simple, they're just triangles in nature, and you need to keep in mind that rectangle pattern are bounded by parallel lines always, and the same general pattern has non-parallel boundary formation of a triangle pattern. Triangles can result in an upward sloping. So this image is basically of the triple bottom which we saw up, and this is how triple bottom is: breakout, pull back, and throw back, and then it goes up. Okay, so let's look at this lower bound, downward sloping. So there are different ways how triangles can be. So the first thing is, you can have a triangle like this with a trend line sloping downwards and sloping upwards, and there can be a breakout either on the upside or breakout either on the downside. You can also have, let's say, a descending triangle where it breaks out from here, or you can have an ascending triangle which is like this. Okay, in this section, we will look at the standard triangle patterns. In these triangles, the point at which two lines extend and cross over each other is called the apex or the cradle, and the distance between the first high reversal point and the first low reversal point is known as the base. Let us talk about what they are saying. Have they given any image of that? Right. Okay. So this is a standard triangle pattern, and we can see that this is how a standard triangle is. And see, this point is where both these lines coincide with each other, and this point is known as a cradle or apex. So when you have a standard triangle, see, the reason I'm making these diagrams and short notes in the middle is because to have the notes with you. So this is how my triangle is. At this point where both these lines meet are known as apex or cradle. And what is known as the base? The first reversal point to this is known as the base. Keep that in mind, please. Okay. Alright. Reversal point, first low of the point. Okay. When the low bound is a horizontal support line, lower bound is a horizontal support line, and the upward is a downward slanting trend line, which means like this, we can see that the price is clearly coming downwards. The highs are getting reduced, but the lows are remaining the same, which means that the lows are strong, but the highs are coming down, which means the price is descending. The price is coming down, which is why it is called a descending triangle. When the lower trend line is rising, so when the lower trend line is rising, but the upper is just the same, then we can say that the stock is ascending, since the lows are getting reduced and the highs are getting just the same, which will show that the price is ascending in nature. When the upper bound is declining and the lower bound is rising, which is a standard triangle which we were seeing, that is known as a symmetrical triangle. So this is also known as a symmetrical triangle. When is it a symmetrical triangle? It is a symmetrical triangle when the upper bound and lower bound are both coming towards each other. Okay, and then when both the upper bound and the lower bound are slanting in the same direction, it is called as a wedge. So what is the difference between a wedge and a symmetrical? So what we saw, this was a symmetrical triangle, and what is a wedge? This is a wedge. There are slanting lines, but both the lines are going towards the same direction. These are known as wedges. So keep that in mind. All right. When the two lines are diverging regardless of the slope and reverse triangle, it is called a broadening pattern. So what is a broadening pattern or broadening? See, if you look at this, the price was first broad and then it converged and it came together. Here also, so here also it's converging and it's going together. Broadening pattern, here is it going together? It's in fact staying the same. They are not coming together at all. So broadening pattern is when the price was initially together and then it goes like this. So which would mean that the price is broadening. Very simple. Okay. So when we talk about a broadening pattern, we get uh, a diamond pattern. We know what a diamond pattern is because we have discussed it in the level 1. Okay, next we have the descending triangle. We have already discussed what a descending triangle is, and the picture is also given over here. We need to keep in mind that price should touch each line at least twice. So you need to make sure that there are at least 2 touches and should fill the triangle space. So it can't just come here and go up again. It should come here, touch down, and then only go up. So minimum 2 touches. So, but the upward breakout is more reliable and profitable. So you need to keep in mind that the breakout usually happens on the downside, but you need to keep in mind that if the breakout occurs on the upside, that is more profitable. 47% to 16%. This formation can be stretched high and wide, and sometimes it becomes very difficult to recognize. Now, this is a descending triangle only again, and you can see that from here there is a breakout. So this probability is more. That's what they are saying. However, prices often explode out of it and produce sizable gains. It can also be wild and guarantee and exciting that it will break out and run, break out and pull back. So anything can happen. You need to enter on a breakout from a descending triangle. The subsequent action must be watched carefully and you need to really manage your risk. So upward breakouts on gaps add considerable performance and are definitely something to look for. On downward basis, gaps seem to have little effect. Average breakout distance from the base to the cradle is 64%, most powerful at 80%. Entering from below equals to high and upward sloping volume. Obviously, like we have discussed that whenever we have a breakouts, we really want that the volume is something which is very high in nature. Next, we have what is the ascending triangle. We know what is ascending triangle. Again, similarly, breakout on the downside is more profitable as compared to the breakout on the upside. So, upward breakouts occur 77% of the time, and the breakouts happen 61% of the distance from the base to the cradle. The overall performance rank is roughly in the middle of all of the patterns, with little more favorable to the downward breakouts. Failure rates are between 11 to 13%. Okay. Next, we come to the symmetrical triangle, which is also known as an isosceles triangle or a coil. So, an isosceles triangle or a coil is when the price is basically like this, both of the trend lines are coming towards each other. This is also known as a symmetrical triangle, or it is also known as a coil, so keep that in mind. So in this situation, you know that the price can either break out towards the upside and go up, or it can break out towards the downside and it can go down. So the prices must again touch the trend line at least twice. So you need to know that 2 times at least it has to touch, and it needs to cover the entire area of the triangle, right? So it can't be something like the price went like this, and then we can't say that this is a triangle. We want the price to come and touch the and complete the area of the triangle. Okay. Volume usually trends downwards during the pattern formation, and the breakout is usually upward. So we want the volume to be low during the formation of the pattern, and we want the volume to go high as soon as the breakout occurs. So keep that in mind. This we have discussed. Okay. Gap breakouts do not seem to affect the performance on the upside, but they do give you extra percentages on the downside. So this is what has been observed when it comes to the coil triangle, that gaps on the downside give extra points, but gaps on the upside do not give points, whereas in the other triangles we were seeing the opposite. Okay. Also, when we talk about the volume, high volume on the breakouts, both upward and downwards, adds considerable to the performance of the formation. So obviously, so we want to look at the formation. We want to see that during the breakout there is a very high volume, but during the formation there is a low volume. Okay. Now we come to trading triangles box. The ideal situation for trading triangles is a definite breakout, a high trading range within the triangle, and upward sloping volume trend during the formation, and an upward sloping volume trend during the formation of the triangle, especially a gap on the breakout. These patterns seem to work better with small cap stocks in a rising market. Something to keep in mind. Triangles are plentiful. For example, the upward failure of a head and shoulder top before any break through the neckline. Okay, head and shoulder. I don't think you know what that is right now, but you have done it in the level 1. So I'll just quickly give you a brief. This is the head and shoulder pattern, and there is a breakdown from this is the head, this is the shoulder, and there is a breakdown from the shoulder, and then the price goes down. Alright. Alright. So when they talk about the volumes, there is something which they want us to keep in mind, that generally what happens is that the volume trend during the formation of the triangle declines, but in the case of an upward breaking descending triangle, an ascending triangle, and a downward breaking is not a reason to disregard the pattern. The volume on the breakout seems more desirable in symmetrical triangle but cannot hurt in others. Gaps are better predictors of performance in the upward breaking descending triangle. So we need to make sure that volume is something which is extremely necessary when it comes to the symmetrical triangles, but it's not that necessary in the other breakout things. And how do you get the target of the triangles? So to calculate the target, you basically add the base distance to the breakout. Very simple. Let me show that on a real chart. Which stock do you want me to do it in? Do you just want me to do it on Nifty itself? Okay, I will do it on Nifty. Alright, so if you look at this, just an example, I'm just quickly giving you some example. And if you look at this low, if I connect this low to this, we can see that there is a triangle, and here there has been a breakout of the triangle. See, went up, came down, went up, came down. Here there's a shortfall, and it went and it broke out. So what would I have done? I would have entered above the high, somewhere like this. I would have entered over here, and I would have placed my stop loss at the breakout region, and I would book my target. So how would I book my target? The low and high, and like you would have measured the apex, the first high, let's say that to the low is this much, and you would place it at the breakout area, which is like here. Yeah, so would that have been met? Let me check. Yeah, so basically you would have exited somewhere over here. If you had a reasonable stop loss like somewhere below over here, then you would basically have even captured this whole move. So that is something. Okay, so the stop loss hasn't been discussed in the book, but what I would do is I would keep the stop loss below the breakout candle. Okay, now let's come to the broadening pattern. So broadening patterns are same thing. So until now the patterns which we saw, the patterns were not broadening. In fact, the price was converging, right? Until now, whatever patterns we've been seeing. But now what we're going to see are broadening patterns, which means the price is not coming together. In fact, the price is going away, and the price is basically going away from each other. So that we are going to see. So broadening pattern exists when we take a standard rectangle pattern and draw the bound lines diverging from each other. So instead of converging, they are diverging. Okay. And what are the kinds of broadening patterns? We have megaphone, we have funnel, reverse triangle, and inverted triangle. So we will be discussing each of these patterns one by one, so don't worry about that. Okay, so this is just all right. What is this? A number of clothes. Just a second. This is an incorrect. Yeah, so we are over here now. Okay, so now if you look at the pattern which is given over here, you can see that initially the price was converged together, and then with time the price diverged from each other. So how do you trade stocks like these? You basically wait for the price to break out from this widening pattern, and when it throwbacks, you enter over here and the price basically goes up. So that's how you basically monetize on the broadening patterns. Okay, so we have broadening ascending, broadening wedge as well, which you know what a wedge is, and now just imagine it to be ascending, and imagine it to be widening, which has both bounds. Upward breakouts in this pattern are ranked 6 out of 23 and have failure rates of 2. So they are talking about wedges, upside rising wedges like this. They're talking about this. So that has like very less failure rates. Broadening formations are the least useful patterns. So they are the least useful patterns because first of all, what I believe is that the to keep a stop loss in a broadening pattern is extremely difficult in nature. So that is one thing. Secondly, broadening patterns are the least useful patterns. They are relatively rare in occurrence. They are firstly very rare, and then they are difficult to identify. They are also very difficult to profit from because you don't even know how to put the target in that. The boundary trend lines are separating over time, so things keep changing in these patterns. The raw performance statistics show the performance is average at best and the failure rate is above average. So now there is just one which I really like and which I think is very favorable, which is the diamond top, which looks something like, let me show. When we are talking about the diamond top patterns, it is like this. The price is broadening, again broadening even more, and coming together again. And here it will break out, you enter here, and then it will go up. And how to measure the target? You measure this point to this point, how much this is, and that much only from here you can expect the target to be. This is the diamond pattern, and this is one of the widening patterns, and I really like it because it is very rare and it forms really rarely, and whenever it forms it always gives you good accuracy. Also, I know that the videos which I make are extremely um, lengthy in nature, and it can get really boring after a while, but what I make sure is that I want to cover each and everything which is given in the chapter. And while you are studying this chapter using my video, you don't have to go back to the book and read it again. I want to make it that good. Even though that is not advisable, I would always advise that everybody has to take out their own time and they have to read the book and learn from it after watching this video. But by the time you watch my videos, you're already 90% done with the chapter, and you are already 90% done with the concept that just reading the book will make it easier for you. So that is the reason why my videos are this lengthy in nature, and I cannot really do anything about that. Okay. Then we have what is the diamond top, which I just discussed, and it is very less frequent, like I mentioned, but it is a very profitable pattern. Okay, and it has a combination of the converging as broadening. It is a combination of a broadening as well as the converging pattern, and it usually occurs at the top, but it rarely occurs at the bottom. For example, there's an uptrend going on here. Now there is a diamond pattern, and then either it's continuing or it's going down. It combines two triangles. In standard broadening formation, the upper trend line is upward, therefore has two peaks. Okay, so they are basically explaining the difference. Now this is how my diamond pattern looks like. So they are saying that it is like this, and here you would exit, breakout, and then it will pull back and it will go further down. So in this case it would basically be a reversal pattern, so keep that in mind. The first reversal point on entry direction, of course, obviously your, so whatever you reversal would be in the direction of the entry direction, right? The trend lines in a symmetrical triangle coverage, as in all standard triangles, must have at least two peaks and trough. So we've always been seeing this one thing standard in all of the patterns, is that we need at least two minimum touch points before you say that a particular thing is valid. Balkowski's figures show that around 58% of the time, the preceding price action in the diamond top was a steeply rising trend. So it's rising, then there is a diamond, okay, and the odds increase the breakout would be on the downward. So here there would be a downward breakout and it will start going down. Diamond bottoms have the same configuration as the diamond tops. There are number one performance when they fail the breakdown. Okay, so number one in performance when they fail and break down. So that is what is said. Even when they break upward, their ranking is 8 out of 23. Okay. All right. And when we talk about the volume usually declines during its formation, and indeed, rising volume is a plus if it happens after the breakout. So this is something which is very common for most of the patterns, that we really want the volume to be low in the formation, but we really want the volume to be extremely high when the breakout happens, because that will basically give you a sort of confirmation before you basically enter into a trade in the particular direction. Okay, and then now we have pullbacks. So pullbacks, we know what pullbacks are, and I would always advise that you need to enter only when there is a pullback. The diamond formation, once properly defined, tends to have a fast moving price run on the breakout. If the post breakout price behavior is sluggish, the position should likely be closed, or a close trailing stop loss must be placed. So we need to make sure that the trend after the breakout is really strong in nature. If it's very slow and if it's not happening fast, because usually what happens is when you're trading a diamond top, the direction or the price moving in our favorable direction happens on a very quick basis. So that is why they are saying that you need to make sure that it happens quickly, otherwise you need to close your trade or set a proper stop loss. The price objective is usually the distance that the entry price travel to reach the diamond. Moving on, now we come to wedge and climax. We already know what a wedge is, and we know that in a wedge both of the lines are going in the same direction. So a wedge pattern is actually a triangle pattern with both the trend lines which are heading in the same direction. So a rising wedge has both the trend lines which are going towards the upward direction, and with the lower bound rising more quickly as compared to the upper one. Like you can see in the image, you can see that the lower line is more steep as compared to the upper line, and the declining wedge has both of the lines which are going towards the downside. And yeah, if you can see, and we can see that the upper one is going more faster as compared to the lower one. Okay, the line crossed in the future just as a standard triangle, and everything else is just the same like a triangle. And you know that wherever the lines meet together, that is known as the apex or base. That's known as the apex. Okay, so now if you see that this broke out and there's a pullback, so I would enter over here and it would go down. Now, what is a climax peak? So before a wedge actually happens, before it comes into a wedge formation, the price usually has a very sharp uptrend and then it goes down and then goes. So this peak earlier where it went, that is known as a climax peak. Now when we talk about a channel, what exactly is a channel? In a channel, we know that there are two parallel lines, okay, and those two parallel trend lines are either rising or they are declining, and they can either be like this, they can be like this, or like this. Okay, so in earlier discussion of channels, we noticed that when the channel line drawn parallel to the trend line through the opposite set of reversal points begins to slope towards the trend line. So what they're exactly saying is that, let us see Through an example, in an upward sloping channel, the channel line above the trend line connecting the downward reversal points begins as the line parallel to the upward trend line. Let me show you the image. Okay, first you see this. This is basically my declining wedge, and before a declining wedge, usually what happens, the price declines more and comes up. So in before, when we were seeing a rising wedge, that was known as the climax peak, right? So here this is known as the climax trough, or it is also known as the panic. You need to keep that in mind. And right, okay, so now let's talk about the statistics, and we also know what is a rising wedge, right? Okay, so all of the declining wedges, which means the wedges which are going down and they break up upward, the most rising wedges break out to the downside. So rising wedges usually break out to the downside, and the downside wedges usually break out to the upside. That is something you need to keep in mind, since they are like kind of the opposites. And wedges, when we talk about wedges, they are one of the few patterns that can be consolidation patterns against prevailing trend. So if the prevailing or the usual previous trend is upside, then wedge can break into the downside, right? So that you need to keep in mind, that wedge is usually more successful in the opposite direction. So that you need to actually keep in mind, and that's the specialty of the wedges. Okay, and they occur more often during consolidations, but are more dramatic after a climax. So you need to make sure and see that there is a climax, because that will basically increase your profitability. So looking at the rising wedges first, so they occur, so since we've been discussing the opposite side, right, of the wedge, so rising wedges occur either during a long downward price trend or after an upward climax. So when there is an upward climax, then we have a rising wedge, right? We know that, we just saw the picture of that here, that rising wedges occur when there is a climax peak. Or the second thing is when there is a long downward price trend. After long downward price trend, there can be an upward wedge, which means that there is going to be a shift in the direction. Okay, and similarly, there are some which occur during the downtrend, but like we've mentioned again, they break again to the downside and continue to the downtrend. So declining wedges are almost the same pattern, and it is in the opposite direction. So the way we've been discussing about the rising wedges, the opposite of that is that. Okay, so when does a market climax actually occur, and why does the climax occur in the first place? A market climax occurs when the prices accelerate or when the people panic in the market. Okay, so the underlying trend line is gradually adjusted at a steeper slope in line with the direction of the prices. In an upward accelerated trend, the support reversal points occur at the levels higher than the projected trend line. Okay, so keep that in mind. Now, when we have a climax low, which means after a panic, that is the trough, that is the downside. So it, you should see that okay, what is missing over here? Let me just check from my So to test the wedge at declining variety. So let's see the figure again to understand it better. So this is the figure of the declining wedge. So keep in mind that the declining wedge and the upside wedge, usually they are more successful when the breakout happens in the direction which is away from the direction or the slope of the wedge. Wedge is a reversal pattern even though it may not occur at actual climax peaks. Other rising wedges can occur as a consolidation during a sustained downward trend and occasionally will end at the top of the weakening uptrend. Okay, so these are the places when we can have the rising wedges. Keep that in mind. Because trend lines often converge in the same direction when a wedge is not present, Bolowski requires that at least 5 reversal points to be touched. So 5 reversal points are to be touched to confirm that something is a wedge. Until now, what we've been seeing in triangle was that you needed 2 reversal points. But whenever we are talking about a wedge, we need 5 reversal points, so keep that in mind. Okay, so what do you understand by the 5 reversal points? It means that we needed 3 points on one trend line and at least 2 on the other. Otherwise, the trend is not a wedge. I will show you some examples of the same. So if I look at this is a wedge, right? This is a wedge, and this is a wedge. Okay, so if you look at it, if you extend it even more, then there will be 5 points, right? So 1, 2, 3, 4, 5, okay, 6. So, and here 1, 2, 3. So what would I do? This is a rising wedge. So since it's a rising wedge, I would want to enter when it breaks down. Okay. So initially, what was the trend? The trend was uptrend. So I can assume that from here there can be a downtrend. So I would enter over here. Stop loss would be above the candle, and I would take 1:2. So 1:2 hasn't been met, but 1:1.5 has been met. So keep that in mind. If your what do you say? Just a second. Yeah, 1:2 has actually been met. See, this is the candle. The candle on Monday, 12th February is the one which closed below the trend line or below the wedge. So I would enter over here, stop loss above the candles, and then 1:2 target. Again, now I am not really going into the detail of this particular trade because this won't be the only reason why I'm taking a trade. The reason why I'm showing you is this is to just show you guys how it actually works. But it's also possible that my stop loss must have hit in this particular trade and the price must have continued going up. So that's why I'm saying that whenever you are trading a pattern, you need to also confirm it with proper things. So I wouldn't have entered over here, and according to me the stop loss has been met, even though 1:2 has been. But why? Look at the corresponding volumes below. The volumes are not that high at all. Like if my volumes were a spike like this, then I would have maybe taken a trade. But here I can't see any sort of conviction since the candles are also not that great, and the volume spikes are also not that great. So that is my concept of wedge. Another characteristic of wedges in both the consolidation and the reversal varieties is declining volume during the formation of the wedge. So during the formation of the wedge, we want to have a declining volume. Declining volume occurs in 3 quarters, and then whenever it breaks out, the volume increases. So that is something which I really want on my sorry. That is something which I really want on my wedges. Breakout volume seems to be irrelevant to the performance, but you need to make sure that there are some sort of pullbacks and throwbacks because they have high odds of occurring. So, yeah. Okay, now when we talk about the performance rank for the wedges, like we have discussed for the other things, we can say that the wedges, the failure rate is considerably low for the upward breakouts and the downward breakouts. The rising wedge, which is downward breakout, is the least reliable. So when we have a rising wedge with a downward breakout, that is the least reliable pattern, which you can say. All right. So now we talk about trading wedges. So when you talk about trading wedges, how do you trade a wedge? So it pays to wait for that breakout and to act immediately on it. So as in when the breakout occurs, you need to act on it immediately, otherwise you will lose it, right? And wedges also have such a high percentage of breakouts in the direction opposite from the wedge direction. So that I've said a million times that when the wedge is rising, the breakout happens on the downside. When the wedge is falling, the breakout happens on the upside. So the breakout is usually in the direction which is opposite of that of the wedge. Keep that in mind as well. And this is one of the most profitable patterns. Just be sure that a wedge is described properly before anything is given. Whenever a climax has occurred, whether up or down, look for a wedge to form on the test. Okay, so whenever there is a climax, you saw a climax, then wait for the formation of wedge. Alright. Until now, we have been seeing straight edges. Now we are starting with the patterns which have rounding edges. When I talk about rounding, that means that, okay, so whenever we were talking about wedges or patterns like that or W pattern, so the upper line or this upper area acted as a resistance or as a support, right? But now when we are talking about rounding patterns, then you should understand that if we are doing a cup and handle pattern, then there is a support region, but the support region is curved in nature. So that is something you need to keep in mind. Okay. um, all right. So the patterns which we have done till now are defined by straight lines, like I've mentioned, and now we are starting with the curved lines. The very first pattern which we are going to see is rounding top or and rounding bottom. So rounding top, rounding bottom are also known as saucer, cup and saucer, or bowl, cup, saucer. Keep that in mind. So rounding tops and bottoms are formed by price action that reverses slowly and gradually rather than differently from the spike with definite and sharp reversal characteristics. Let me first quickly show you the picture, then we'll go back to the theory. So look at this. It's like a cup or a bowl, and then it goes down, and then it breaks out from here, and then it goes up. Few things you need to keep in mind is this is the lip of the bowl or lip of the pattern, so keep that in mind. This is the lip, so where it touches the thing and goes down and goes, this area is known as a lip, and this is known as the handle, and this is the breakout. Now let's go back to the theory. Let me just quickly show you one example on TradingView. Even though it is a bit difficult to find, I will try my best to find the pattern. Alright, if you look at this, this is not cup and handle, but there is a double top pattern over here which broke down. Even though it did fail, if you look at it, it went back up again. So that is why I always keep saying that you need to confirm it with volume and everything. Yeah, so if you look at it, here there was a breakdown. Actually, it did not fail. Look at this. It went up, came down, went up again, came down, and it broke out. It did give you this much distance, but yeah, okay, well, it failed. So whenever you are doing M pattern, it is very necessary for you to confirm with the volumes and other indicators, whatever works for you. Okay, let's look for cup and saucers. All right. I haven't yet come to head and shoulders yet, but I can clearly see a head and shoulder over here. One shoulder, head, shoulder, and here there's a breakdown and it went down, and my target has been met. How much is my target? The area of the head would be my target. So that's how I would enter. And how would I enter? I would enter basically below the closing of this red candle over here, which whatever closes below the zone. Okay. Okay, now let me look for a cup and handle. Okay, so maybe you can consider this. Look at this. Okay, now how did I draw this? Oh my god, where did that go? Yeah, so if you look at this, the price basically it's been coming down, went up, came down, but didn't go till that bottom and went up again, and then it went up. So this is one of my rounding saucer pattern or a cup and a bowl and that. So this part is my lip, this is my handle. Okay. Let me go back to the theory and complete the theory, whatever was there. Alright. So now let's talk about the volumes when it comes to this particular pattern. Volume in the bottom seems to follow the same trend of lessening as the prices gradually approach the bottom. So when it's consolidating, when the pattern is forming, the volume is usually low, and rounding usually takes time, and within the process it has many minor ups and downs. Rounding is thus more conceptual than specific, and the volume at the breakout is always advisable to be high. However, many formations depends on rounding for their description. So the most famous is the cup and handle formation. Okay, and cup and handle formation is what the example which we just saw, and we know what a lip is, we also know what a handle is. The high of the lip establishes in this type of rounding bottom. Lip is the highest point of the thing, and it is also the resistance level, and once the resistance level breaks, that's when you enter. Traditionally, the cup and handle is considered to be a bottom reversal pattern. What do you mean by a bottom reversal pattern? Usually what happens when there is a very steady downtrend, the price is going down, and here it makes a cup, and here it breaks out and it starts going up. So cup and handle is usually a reversal from the downside pattern. Obviously when it's going up and it makes a cup and handle, then it'll act like a continuation, but majorly it is important to know that it acts as a reversal pattern. Okay, but now there's one thing you need to keep something in mind, that it is not that good. It is very popular. Cup and handle is very popular, but it is only 13 out of 23, which is why it is very common and widely used, right? People know about it, people talk about it, but that doesn't mean that it is very effective in nature. Rounded bottoms are more common than the rounded tops. So, as compared to the rounded tops, rounded bottoms are only more common. Okay, so but neither materializes often. They tend to be longer term patterns, more easily identified in weekly or even monthly charts. So, whenever you are using the cup and handle, saucer, bowl patterns, then make sure to use it on a weekly chart or a monthly chart, because they basically take a lot of time to form. If, like, even now, whatever we've been seeing, okay, that was the daily chart, but on weekly and monthly chart, if you look at them, it's usually formed on them only. They are reversal patterns but can also appear in long consolidations. Shorter term rounded formations, often called as shops, scallops. I think this is scallops. Scallops. Okay. So, whenever you're talking about short term formations, they are known as scallops. Alright. So, rounded bottom ranks 5 out of 23 in performance and have low failure rate. Tops have also the same performance. Top, you understand what a top is? Just invert this and you can see in an uptrend there is a sauce and pan, and then it goes down. Not sauce and pan, cup and saucer, whatever the name is, bowl, saucer, cup, rounding bottom, rounding top, cup and handle. Okay, so that. Now we come to the next one, which is the head and shoulder. There's nothing to discuss in it. You know what a head and shoulder is. So I will not go into the detail of it. Let us just see the characteristics. It is more often seen at the top or bottom. It can be inverted head and shoulder. It can be normal head and shoulder. Mostly it should be treated only after it has formed completely and you need to wait for a breakdown of the same. Its complexity causes many impatient analysts to anticipate its formation. So you need to wait for a breakdown to occur. You need to, if let's say you are trading a head and shoulder like this, you can't just enter now. You want to wait for a red candle like this. Only then you can enter somewhere over here. Do not enter before and do not anticipate that the head and shoulder will be completed. Okay, so this is how my head and shoulder looks. This is my left shoulder, this is my right shoulder, this is where it breaks down, this is my head, this is my neckline, and this is my pullback. So until now, I hope you are clear with pullback and throwback definitions. If you want to pause the video and read this, but I've explained everything, and this is the inverted head and shoulder. Very simple. Okay, we are almost coming to the end of the chapter. Let's just quickly finish this. Okay, next, moving on. The peaks in the head and shoulder top formation are roughly equidistant from each other. So the tops are roughly equidistant. That's the reason why we make it a head and shoulder pattern. That is one of the key characteristics. So symmetry is very important. Keep that in mind, and it makes the formation more identifiable. More than two shoulders appear. So sometimes that can happen too. So keep that in mind, and don't think that if there are more than two shoulders, then it is not valid or stuff like that. And there is also the unbalanced version, but it is difficult to describe them. By unbalanced version, they mean that the both the shoulders are not in the same direction and stuff like that. Next, we have the bottoms between the peaks. When I say bottoms between the peaks, that is like if this is my head and shoulder, then this is my bottom, this is my bottom, right? So that's what they are talking about. The valley is what they are talking about. The bottoms between the just a second, where is it? The bottoms between the peaks are called as the neckline. So this is the neckline. I hope you are clear with that. And when the neckline is breached, that's when you enter into the trade. Okay, so sometimes tilting happens, but it basically obviously has its consequences. Volume is usually the highest on the rise into the peak of the left shoulder and decreases throughout the formation. So whenever the shoulder is rising, during that time, the first shoulder when it's forming, then the volume increases, but after that in the rest of the formation the volume is less. So keep that in mind. Just a second. Yeah, so keep that in mind whenever you are trading a head and shoulder. Yeah, even though it's not a requirement, because because if you think about the volumes and if you think about it, it's less frequent, and they have slight performance of edge at the top. Higher volume on either shoulder does not affect the performance, but higher volume on the right shoulder than on the left shoulder considerably to the post breakout performance. So we really want a higher volume when it comes to the breakout, so keep that in mind. Breakout and action signals occur when prices, after completing the right shoulder, break below the neckline. So we are not going to enter into a trade until and unless there is a clear breakdown below the neckline. The breakout is a requirement for the formation. Second guessing before completion of the pattern can be dangerous. Repeating again, do not guess before it happens. Okay. Now, when we talk about the failures of the head and shoulder, what can they be? So, first of all, mm, you can see that the head and shoulders is when the price break below the neckline, but as soon as they break below the neckline, they go back into the head and shoulder. So that kind of failure might happen. And again, why does that happen? We already know that if we don't confirm with additional factors, it can occur. And not just that, even since it is now widely used and widely recognized, because of that also its effectiveness can has been decreased. The breakout often occurs on increased volume, but a decreased volume is not a sign of impending failure. But then it is always advisable for you to make sure that the volume is high when it breakouts. Okay, one thing to keep in mind: increasing volume on bottom formation improves performance. Decreasing volume on the breakout from a top pattern increases performance. From a top pattern increases performance. Okay, now this is about how much the pullbacks and the um, throwbacks occur. The performance rank for the standard head and shoulders is top 1. Okay, so it's the best thing so far. Complex tops have a rank of 3, standard have 7, and then 9. So we have seen most the pullback and throwback occurs. This is true. The failure rates for top and bottom formations are low, only 3 to 4 failed. So this is also something you need to keep in mind. Okay, now let's see what's given in the box. Alright. So again, the same thing is given in the box, that you need to wait for the the neckline to be formed, and you will enter only after the neckline is formed. And when you talk about the price target and the neckline is broken, only then you will enter. And the price target is basically very accurate. So you take the head of the height of the head and you measure it from the breakout area. Okay, that's it. Now we come to shorter continuation patterns, and that is the flags and pennants. They flags and pennants also have a very famous name, and they are known as half mast formation. Do not forget this, because this is extremely important. Half mast formation. Flag and pennants are also known as half mast formation. Okay, so let's talk about flag and pennant. It's also known as flag and pole. I don't think that would be given in the exam, but it would be given as flag and pennants only. So the price is going, the price basically consolidates like this, and it consolidates like this and breaks and goes up. So you can see that there is a pole, and there is a flag, and then there is a flag breakout, and then the price went up. So this is what a flag and pole basically looks like, and you need to keep that in mind. For efficient use of trading capital, consider trading with flags and pennants. They are frequent formations with extremely rapid and relatively reliable outcomes. After breakout in either direction or either pattern, prices usually run immediately, having few pullbacks or throwbacks and low rates of failure. Some successful traders only use flags and pennants because of these advantage. So it's very important, right? Flags and pennants are variations of the same formation. A flag is a short channel that usually slopes in the opposite direction of the trend, which means that if there is an uptrend, then the flag is towards the downtrend and then it breaks towards the upside. And a pennant is basically a short triangle that does the same thing what a flag does. Now look at the diagram which is given below. We can clearly see that a flag is consolidating in the downward direction and then it breaks out towards the up. And similarly, a pennant is like a small triangle. The only difference between a flag and a pennant is that a flag is a parallel channel and a pennant is a small triangle. And when you moving on, we can see that flags preceded by a rise of 90% or more, having a zero failure rate and an average return of 69%. So that's what it is, if you follow one particular pattern with utmost discipline and take every single trade on that pattern, then you will literally get a 70% return. Okay, so just a second. Yeah. So flag formations occur over a short period, usually a few days to a few weeks. The best flag is less than 15 days. So keep this in mind that the best flag is always when it occurs within less than 15 days. Volume usually declines throughout the formation, and when there is a breakout, then you need a higher one. In fact, this downward trend in volume is found in almost 4 out of every 5 flags that occur. The pennant pattern is the same as the flag, but you know that the trend lines converge, forming a miniature triangle instead of being parallel. In the flag, you know that they are parallel. The direction of the formation is usually opposite from the immediately preceding price trend. We know that, we've just discussed that. And pennants also differ from wedges in that they are shorter in time. So the duration taken by a wedge is significantly more as compared to the duration which is taken by a pennant. Falling volume throughout the formation is even more common with pennants. 90% of the pennants have downward volume. So during the formation, it is usually said that the volume is supposed to be really less during the formation. Now let's discuss the type of failures which can occur when it comes to the pennants. First, at the breakout in the opposite direction from the previous trend. Second, a failure can occur after the breakout. So a flag or a pennant is usually a continuation formation. So keep that in mind, that flag or pennants are usually continuation, which means the trend which was going on before that only keeps continuating. When the break happens in the opposite direction, then it might become go back to the initial thing. Now let me see what's there in the box. So in the box you can see that patterns are given, and half mast formations. What are half mast formation? Half mast formations are flags and pennants only. Here they have just given the examples of the trades or in US steel. So if you look at this is a head and shoulder and it has been broken and it went. So this was a continuation pattern. And then here you can see that there is another pattern over here which broke, and again there's a continuation. Okay. Moving on, when we talk about long-term bar charts with the best performance, we have selected several patterns. So when you're talking about long-term specifically, let's see what, let's see which patterns are you supposed to choose when you are referring to the long-term charts. Okay. So they have also given you results. So they have head and tight flag breakup, head and shoulders, triangle, diamond top, rectangular pattern. They have also given you whether it's a break on the upside or a break on the downside. So you can see these, and these are the performances. All right. Now let's come to the conclusion of this chapter. So profitable use is not easy, since you need to be very very regular with it, consistent with it. The potential problems with recognizing and acting upon the chart problems have been discussed. There are many variables in the price behavior, mostly human, and being human ourselves, we are subject to biases. We must be adaptable and we must be always open and flexible to the changes. And it is unlikely that researchers will ever be able to prove definitively, so we can never be able to prove the statistics of the same. And you need to always be consistent, and we need to evolve with the changing markets. So we are done with this chapter, and I had expected to do this chapter as well as the short term patterns chapter in this video, but I think this is already a very long video, so I'll just end it over here. In case you would like to watch more videos of CMT level 2, then make sure to check the description box below. There would be a button to join the membership. Click on that and make a payment of nearly $1, and then you'll have the access to the level 2 playlist. And level 2 playlist, the videos will be rolling out one a day from now. Thank you.